to the Global View on this Tuesday. Well, let's check out what's going on at a macro level, I should say. Yields on the 10-year Treasury note holding just below 16-year highs ahead of the Federal Reserve's decision on interest rates. While it's expected to leave rates unchanged, the markets are preparing for those rates to remain elevated for an extended period, particularly now that rising oil prices are seen as fueling inflation. 10-year yield at 4.31% and the 2-year rising to just over 5%. The US dollar eased against most major currencies but remained near a 6-month high as traders await interest rate decisions this week by the Fed and also the Bank of England and Bank of Japan. The Aussie dollar trading at 64.4 US cents. Well, for more on the global week ahead, we're joined by John Blank from Zacks Investment Research. John, very good to catch up with you again. Thanks for joining us here at ausbiz. So it is all about central bank meetings this week. Of course, the Fed. We've already had the ECB, as I mentioned, got the BOJ and the Bank of England ahead as well. How instructive was what we heard from the European Central Bank last week, where pretty much signalling that its rate hikes are at an end?
That's it, Andrew. I mean, they told us their rate hikes are at the end. The Federal Reserve System's probably going to follow suit. The CME futures are 97% on no hike. Hard to fight the market like that. It's a consensus that they're not going to hike in this September meeting. But I think it's more interesting to look at November, December, and the same futures only have 37% chance of a hike. So that's kind of what the ECB said, is that there's basically 1/3 of a chance they even do 25 basis points 2-3 months from now. That's what's interesting, and you see that in the 2-year being at 5.06, but the 10-year being at 4.3. I mean, the market's already pricing in 25 point basis point cuts next year already. So everybody is in this sanguine view on inflation, sanguine view on the Fed, sanguine view on the ECB, and that's where we're at. And it's the basic truth, Andrew, is when you can get 5% on a CD or a 2-year Treasury, it's going to suck the life out of the stock market. And that's the other thing that's happening.
So when you take a look at what's going on in the States at the moment, what is that threat that's been posed in terms of inflation or reinflation, if you like, as I mentioned earlier, just as far as where those oil prices are going? Is that of concern to you?
Not really. I mean, I think core inflation is what the Fed cares about, but that's not core inflation. So basically, they'll shrug their shoulders at it. But the bigger problem, Andrew, is we still get 7.2% annual shelter costs, which is dragging down at 0.3% last reading, which is still, take 0.3 times 12, that's 3.6% annual rent increases, even at this level, which is still too high. So what's going to happen here, Andrew, is this is going to drag out. It's going to go sideways, and the Fed's going to have to be very, very patient at a very high level with a market that doesn't believe it's going to stay up there for the entire 2024, and the Fed may do that. And that's the big fly in the ointment, is the Fed may stay at 5.25, 5.5 for a year and a half or 2 years, and nobody wants to believe that right now.
All right, so where does that place us from an investor point of view then, John, in regards to what we're seeing in the equity market and given what's going on more broadly with at a macro level?
Yeah, Andrew, I think the main thing I look at is asset allocation right now. I mean, if I'm an investor, I can buy into the S&P at 19 times forward earnings, which is too high. It's been driven up by these big tech stocks, so I can do that. Or I can buy a CD at 5% and sit out this whole market, make 5% guaranteed, not risk any capital. And a lot of people are going to bet that way. And what that's going to do is drain capital out of the risk markets. And that's what's happening. So we're getting a sideways market because there isn't that fervor of growth stock frenzy anymore, because you can just park money for 5% now. And that's going to be the other part of the Fed equation here, is they're going to they already have, suck the life out of the stock market. I mean, the S&P 500, Andrew, is basically flat over the last 2 years. It's up 15% on the year, but it's basically flat over 2 years. So you're getting, 7% return annually over the last 2 years in the S&P 500, or just buy a CD at 5%. So this is the problem right now, that the amount of money in asset allocation context, Andrew, is leaning into fixed income. It's leaning into CDs for the first time in 12 years. Maybe longer. So this is the other thing. I just think it's just this bleed, this drain of trillions of dollars of money that's getting parked. It's not chasing risk.
Yeah. All right. Well, that said, you have brought a couple of stocks, or in fact, three stocks to us.
Right.
We just got a bit of a preview there. Let's get into it then. The first one being Intuitive Surgical. Well, this is the medical instruments sector. Tell us a little more about this and why you like it.
Yeah, ticker ISRG. Now, this is your classic growth stock, right? This is the robot surgeon that the world has been betting on since 2000, for 23 years now. Alphabet and Johnson & Johnson tried to compete with this company called Verb Medical, a couple hundred employees. There are a couple other groups out there that, a couple hundred employees. Nobody can compete with these guys. So what happens here is they make this product that basically does amazing, low, minimally invasive surgery. They sell probably 6 billion of these a year. There's this chart. It's $300 a share for $6 in earnings. So you're basically paying 50, times earnings on this thing. So 50 times earnings. Why should you buy it? Well, this is the story here, Andy. Look at this chart. 2025 will get you up to 7.5. You're basically trading fair value on 2024 now, and you've got a nice growth stock. So you say to yourself, why shouldn't I buy it? Well, you can see they posted earnings. They did well that last time up because you had a green arrow there, Andrew, but they sold off from 350 to 280. And the reason is they told us that this new suite of that robot, their core Da Vinci robot, is going to be delayed 2023. So you have to bet on them coming up with a 2024, 2025 story. And of course, this is baking in the AI story, right? This is a machine that can learn and machine learn and basically train at a high level of precision what surgeons could never do before. So classic stock, but you got to ask yourself, Andrew, here's the same thing we're getting back to on the asset allocation is, do I want to buy this stock at 50 times earnings? 50 times earnings. That's just a really steep number, and you can get smoked really badly at a stock like this. So I would trade it. I would trade it with a tight stop and move it up to 360, but I would put my stops in at 280 and make sure I got out.
Yeah, certainly promising technology. It is the future of surgery, as you say there. Although perhaps a little scary if you head into a theatre and there are no humans in there. It's only machines doing the work. All right, let's move on to the second stock then you're taking a look at, and that is Ingersoll Rand.
Ticker IR.
Yep.
Ticker IR.
Okay, tell us more about this.
All right, Ingersoll Rand is a classic industrial name. This is air compressors, pumps. Look at that chart. This is classic, Andrew. This is what you're looking for as an investor. Look at that. Every year they do a nice rolling upward revision, growth their earnings, always get a nice upward revision to the analysts. Stock tracks it perfectly. So again, they never miss. Look, last time they missed was way back in COVID, middle of COVID. So the stock's it's a darling stock. You bought it $20 back in COVID. It's at 70 now. You tripled your money. The thing, it's brilliant, right? So you say to yourself, what's so brilliant about buying it now? You can look at that chart and tell yourself fair value at 2025. That's the brown arrows, the brown line. That's where the stock's trading at. So there is no value in this stock whatsoever. It is traded up for 10, 12 months, as you can see, and it's reached fair value. So again, super tight, story. Great private equity name. They've done a lot of restructuring on this name. They've figured out all the profitability niches, and everything's baked into the stock. Everything's priced into the stock, and you're buying no value in a stock like this. So this is another problem here. Here's a great name, the industrial name, all that stuff, but there's no value.
Okay. All right. Well, let's pick the third one there. See whether this holds promise. Weyerhaeuser, it's building products, isn't it? What essentially they harvest trees.
That's it. Weyerhaeuser is your classic, old school lumber name. This is your 2x4 name, your plywood name. They sell some logs to China, basically. Sometimes they have a lot of forest land. Sometimes it's a real estate play, but generally speaking, like you talked about, it's home products. It's remodeling. It's decks. It's studs for 2x4s in your house. So what happened here is this was a big name. You can see it drove up from $15 to $45 a share during COVID because of lumber prices went through the roof. People were remodeling their houses and everything looked great. So then it stagnated after opening, and everybody got out of their hive of their activity in their house. So now what's interesting, if you look at those revisions the last few months, they started to creep up. So here's a trade that I kind of like. It's not a really aggressive trade, but you can get into this name in the 30s and drive it back up to 40 on the idea that this slump in remodeling, the slump in lumber is over, and people are going to start to invest in all of this again. Maybe it's a rate play. Maybe it's just the fatigue of waiting things out in the housing market. Maybe it's a combination. But this name is not that expensive. You get a nice turn in the estimate revisions. And you're not paying through the nose on the stock. So it's the only name I would look at in any serious way right now. And it is a number one name on our list. But it just shows you, again, a lot of what we're talking about today, Intuitive Surgical, great name, but already priced in. Ingersoll Rand, totally priced in. And this one is just, you're going to buy a turn nobody believes in yet, get a little bit ahead of it. That's the only trade I can see in this entire market.
Wow. Okay. Well, there it is right there. John, you've done it again, giving us those investment ideas. Thanks for joining us from Zacks Investment Research.
Always, Anna. Good talking to you.
All right, that is the global view for this Tuesday. Just a quick tip as to where we're likely to open in just a couple of minutes' time with the SPY futures there off around 1/3%. Stay with us. The open is just around the corner.